So my name is Mike Jesowshek. I am the host of the Small Business Tax Savings Podcast, run an accounting firm that we focus on servicing lawyers, attorneys, and really kind of where my focus on the day-to-day side is on the tax planning. My goal is to find out, inform business owners, inform attorneys, what is the way that we can pay the least amount in taxes as legally possible. So much from the day-to-day, we find that business owners sometimes are taken away from this area, not kind of being informed on the tax savings piece. And at the same time, they're kind of misinformed with multiple informations. We often hear from people that say, oh, my friend's friend does this in his business, and that's how he pays no taxes. And I think a lot of business owners hear a lot of conflicting information. So really kind of my goal here today, as well as our weekly podcast, is just to kind of share some of that information that we know from the years of doing tax planning. So Darren, you can go to the next slide.
There we go.
Awesome. So the first thing I want to kind of talk about is tax planning versus tax paying. And this kind of goes in that idea of changing the mindset of business owners to think about tax planning. So many people, when they think of the word tax or hear the word tax, they think of filing and preparing and filing tax returns. So filling out those forms, sending it to the state agencies, sending it to the federal government, which all is important, required by law and important stuff. But really the tax planning piece, something that's even more important than that, is happening so much earlier in that process. And so tax planning is something that we say happens throughout the year. We normally start tax planning or really dig into tax planning in June because we know about a half a year's worth of data. We kind of have an idea of where our business is going to go. And we also have a half a year left to implement that within our business. So tax planning is something that happens throughout the year. And then tax prep or tax filing or tax paying is something that we do at the end of the year. And we're just basically taking that information and sending it to the government agencies. So as we kind of talked about, one of the biggest mistakes that we see small business owners make is just failing to plan. Maybe not doing this planning, maybe not knowing about this idea of planning, and just kind of saying, well, I'm making money, so I guess I got to pay taxes on it. And that's kind of one change or mindset shift that we're going to want to encourage business owners to do. And so we always kind of talk about this idea of pre-tax and after-tax dollars. And so I take this quote of, you lose every time you spend after-tax dollars that could have been pre-tax dollars. And I want to kind of give an example of what this means. And to do this, I want to think about a W-2 earner versus a business owner. And let's think about when COVID initially hit. So let's say we're a W-2 earner, we work for somebody else, COVID hits, we're used to working in an office, COVID hits, and now we're working at home. To do that, we might have a home office, we might have internet that we have to purchase or that we're using more of, we might have went out and bought a desk, some chairs, whatever it might be, in order to work from home. And as a W-2 employee, there is no tax benefit. That desk we bought, nothing we can do with that. We don't get a tax deduction for that. That internet, that home office that we're taking up, we don't get tax deductions for that. And so all the spending that we do on that is what we call after tax. We basically get our paycheck, which is our gross. We get all these taxes taken out, and then whatever is left over is our after tax money. And so most of the time as a W-2 person, all the money that we spend is after it's already been taxed, because that's what happens through our W-2 payroll. As a business owner, we get this advantage of being able to move some of that after-tax spending into pre-tax spending. So the business owner, we have income or we have sales, we have all these expenses that go into it, and then whatever's left over is what we get taxed on. And so this is the area that we want business owners to think as much as possible is, how can I take some of that spending that I'm doing anyways, but find a business purpose for it and move it into a business expense. So in that example that I gave, if you are now working from home as a business owner, you can have a home office, that furniture that you're buying, that's going to be a business expense, that internet, things like that, a portion of that's going to be a business expense. And so that's kind of this idea of after-tax and pre-tax dollars. Some of the things we're going to be talking about, again, is something I encourage everybody to do is go through your personal spending and see if you can find a business purpose for some of those things. You'd be surprised at the way that the everyday spending that you do of ways that you can find a business purpose from that. So that's going to be some of the things we're talking about today. But again, the kind of purpose of this is to just bring for the force the mindset shift of, instead of when we hear the word tax, instead of thinking filing forms, sending it to the government, we want to be thinking a little bit more on, where can I save on taxes? Of course, we still have to do that, but where can I save on taxes? And next slide's good, Darren.
There you go.
Excellent. So this is one of a strategy that we implement and talk with clients about, and this is honestly one of my favorite kind of tax strategies. And this is that idea, again, of taking after-tax dollars and turning it into pre-tax dollars. And it's this idea of hiring your kids. And to give you an example, let's just say your kid's going to basketball camps, maybe they're hanging out with friends, maybe you're sending them to some type of training camp or something like that. That's all money that you're spending after tax traditionally. But what if you could take that money that you're typically spending for basketball camps and things like that, move it into a pre-tax expense, now get a business deduction for that, and get you potentially have your children paying no income taxes on it. So when we look at hiring your kids, of course we have to do this the right way. Your children has to be doing an actual work within your firm. They have to be getting paid a reasonable rate for the type of work they're doing. But and we'll talk about this a little bit later, there are some ways that this can happen. And a lot of times I talk to attorneys and they're like, Mike, how can my 10-year-old even help in my business? I'm an attorney. Well, what's a 10-year-old going to do in my business? And that's where I say, let's get strategic. Let's get creative about how we want to do this. And so everybody on their first $12,550, whatever the standard deduction is, pays no income taxes on this. So when you hire your kids within your business, there's potential for you to get a business deduction and your kids pay no income taxes on that payment. And so because they're under that roughly $12,000 a year standard deduction. Now with hiring your kids, there's some things that we need to do to make sure that this makes sense in that situation. So if your children's under the age of 18, there's no need to withhold Social Security, Medicare, or federal unemployment if you're operating as a sole proprietorship or a single member LLC. So if you're operating as a single member LLC, sole proprietorship, you pay your children through your business. You do not have to withhold Social Security taxes, Medicare taxes, federal unemployment. You just pay them their money and they get that funds. You get a business deduction and they pay no income taxes on it, because you also don't have to withhold for income taxes if you're paying them under roughly $12,000, because they're not going to have any income tax on that. So again, what a great way to get a deduction, potentially have your kids pay no income taxes on that. Now, there might be a lot of people on this call that are operating as an S corporation. If you don't know what an S corporation is, we're going to talk about that a little bit later. But if you're operating as an S corporation and you hire your kids in your business, now you are required to pay them Social Security and Medicare and withhold for those types of items. So oftentimes we'll do a workaround with this, where we'll create a family management company that's providing whatever service your kids are providing. We'll have the S corp pay a sole proprietorship, single member LLC family management company who will then pay your kids. And by doing that type of workaround, we're able to avoid that Social Security, Medicare. Other people say, I don't want to do that, but I still want to hire my kids. You can still do that within an S corporation. You're just going to pay Social Security and Medicare taxes on both the employee and employer side, which is okay. You're still getting a tax deduction for that. You're just potentially paying more in some of those FICA taxes than might be necessary. Now, when we talk about hiring our kids in our business, there's a couple key things that we need to think about. We need to pay them a reasonable rate for the work that they're performing. Now, we talked about this idea of a 10-year-old. What are they going to do in a law firm? And so I want to think about this strategically. Can they help shred paper? Can they help do social media for your law firm? Can they help do stuff mailers that you're maybe going to mail out on a marketing campaign or something like that? There's a lot of different areas that a child might be able to help out in your company that you just might not be thinking about at the first level. No, they're not going to do legal work. No, they're not going to be your paralegal at the age of 10, but there might be other type of work that they can do. And that's what I want you to be thinking about. So many times people come to me and they say, I'm just a solo attorney. I don't do social media. I don't do that type of stuff. People just come to me from referrals. And my question to them is always, well, would doing some social media hurt you? Even if you get no clients out of it. But you're paying someone, you're shifting some of that after-tax spending into pre-tax spending. You're teaching your kid how to work in your business. You're teaching your kid a little bit about your business. Why not? What's the disadvantage to that? Even if it doesn't go anywhere, it's money that you're going to be spending anyways, but now we're getting a business deduction for it. So when you're thinking about hiring your kids, I want you to be strategic about that. What are some areas that they can help out? It doesn't have to be $12,000 a year. It could be $1,000 a year. It could be $500,000 or $500 a year. Whatever it might be, finding that happy medium between the type of work they're doing and making sure that they're paying a reasonable rate for that work. Again, that reasonable rate is key. We can't pay someone $150 an hour to mow lawn when we can hire somebody to do it for 30. But as long as we're keeping track of that, again, that's the other piece, is keep track of the hours that they're spending, the work that they're doing, so that we have anything to support this. Should the IRS come knocking, we can say, well, here's the work that they were doing, here's the rate, here's how we came to the rate, and we have full documentation of that. At the end of the year, you're going to want to prepare a W-2 for your children. Now, if you are operating as a sole proprietorship or single member LLC and paying your child out of there, you're going to have a W-2 that has no taxes on it. So if you think of a W-2, boxes 2, 4, and 6, typically you're going to have your federal withholding, your Social Security withholding, and your Medicare withholding. In this situation, those are all going to be zeros because you're not doing any of that. So the W-2 is really just for informational purposes, but technically you should still be filing a W-2 for your children. So again, this is just taking the idea of let's take the spending you're doing anyways, basketball camps, having your kids do some entertainment type stuff. That's spending that you're going to do as a parent anyways. How can we get a business deduction for it and do it the right way by having them work within your business? And there's so many other added benefits to that than just saying, now you're going to work for me in my business. Next slide. All right. The second strategy I want to talk about is the Augusta Rule. And really this kind of came up, some people call it the 14-day home rental rule, the Augusta Rule, but where this kind of stemmed from is the Masters tournament in Augusta, Georgia. What was happening is people were renting out their home because everyone's coming in to go to the Masters, they need places to stay, and so they're renting out the homes, but they're renting them out for like a week and making a ton of money on it because people needed places to stay. But the problem with that is that they were then forced to pay rental or pay taxes on that rental income that they were receiving. And the IRS kind of talked about, and they said, this isn't actually a rental property. You're only renting your house for 7 days a week. So, we're not going to look at this as a rental property. And the IRS put in a rule, if you rent your home for 14 days or less, you don't have to pay rental income on that. So we kind of took this and flipped it and said, okay, instead of just thinking about golf tournaments or the Super Bowl or things like that, how can we work this with business owners? And so that's where we found it. That's where we kind of utilized this Augusta Rule as a tax strategy for business owners. And the idea behind it is what can you rent out your home to your business for to do some activity related to your business, have your business get a business expense, and have you pay no income taxes on that income because you rented your home for 14 days or less. Now, when we think about the Augusta Rule, we don't want to be thinking about a home office. You can get the home office no matter what, and everyone should be taking advantage of the home office. That is separate. This is going to be events or a specific meeting that's happening. So sometimes it might be a corporate meeting that you're having with your team. You might have your team stay over and do a retreat. We just had a retreat for our company last week. You might have an annual shareholder meeting or a monthly shareholder meeting where you bring in your board of advisors to come and talk to you and discuss your business. By the way, your board of advisors might be some family members, might be some of your good friends that you're bringing in. So this is a way to rent out your home for 14 days or less. Now, it doesn't have to be all consecutive. It can be, a lot of our clients will do 12 meetings once a month, board of advisors meeting, and that's 12 days. That's less than 14. But they'll pay from their business to themselves personally and pay no income taxes on that. Business deduction, no income taxes on that. The key thing here is having a purpose for this meeting, whether that's a team retreat, whether that's a board of advisors meeting, having a purpose for it, documenting the type of the meeting, the reason for the meeting. And then the second piece is making sure that you have a reasonable rate for that rental. We can't rent out your home for $12,000 a day. I guess maybe in some cases, some attorneys might have a very, very nice home, and that might make sense. But traditionally, we're going to say, let's vet out some areas, some other places in your area, and see what a daily rental fee is. So if you're having a board meeting there, let's contact a share working space and say, how much does it cost to rent out your share working space for a day? And that might be the way that they find out kind of what is reasonable rental rate. And so it's a great way to just document that, have that email that says, oh, the share working space says it's $850 a day to rent out their boardroom. That's the documentation I'm going to keep on file. Should the IRS ever come knocking, I have that proof there. But again, the Augusta Rule is a way to shift some of that income again. Get a business deduction, potentially pay no income taxes on it personally with very little work involved in order to get that deduction. Next slide. There we go. So the S corporation strategy, we talked a little bit about the S corporation before, and the S corporation strategy is simply a tax election. So most people will set up as a C corporation, or kind of more so in common, we see people set up either as a sole proprietorship, which means there's no state entity structure, it's just a sole prop, or an LLC. And the problem with both a sole proprietorship or an LLC is that you get hit with self-employment taxes on 100% of your income. So if we look at this slide here, if you make $80,000, you're going to get hit with self-employment taxes of roughly $11,000 plus your normal income tax rate. So when you're set up as a sole proprietorship or a single member LLC, you pay self-employment taxes on 100% of your income, plus you pay your normal income tax rate on top of that. There's really no way to eliminate or avoid paying that self-employment tax. And so with an S corporation, we're not changing the entity structure. You're still going to remain an LLC. You're still going to remain a C corporation, whatever your entity structure is set up. We're just electing for it to be taxed as an S corporation. And as part of this, it's key that you do have some type of entity structure set up. So if you're operating as a sole proprietorship, not much we can do. You have to have that entity structure set up as an LLC or C corp in order to do that S corp election down the road. So for that reason, we typically say, when does it make sense to do an S corporation? Once your business is hitting profit of $40,000 to $50,000 or more per year. The reason we take that $40,000 to $50,000 number is because with an S corporation, you have a little bit more complex of a tax return. Corporation we're going to be talking about, you're required to take a reasonable salary to yourself, and those types of things bring in some added cost to them. So if you're under that profit amount, and maybe you already are an S corporation, but you're under that profit amount, it's not necessarily going to hurt you. It's just that a lot of the tax savings that you get might get eaten up by additional fees that you might have. So we're going to talk about kind of what does a sole proprietorship single member LLC compared to an S corporation look like. So again, let's remember this slide here where it says we make $80,000 in income, we're paying self-employment taxes of roughly $11,000, and again we have our normal income tax rate based on our income over and above that amount. Next slide. So now we're going to look at the S corporation strategy, and again, this is simply a tax election. We're not changing our name, we're not removing LLC or anything like that. We're staying the same entity structure, but we're filing a form with the federal government to elect to be taxed as an S corporation. Once we have an S corporation, we have to split our income into two. As an S corporation, the owners are required to take a reasonable salary based on the work that they're doing. So you have to take a W-2 salary as if you're an employee of your own company for the type of work and the amount of hours and everything else that you're putting into the business. That salary is going to get hit with self-employment taxes. Now, we don't call it self-employment tax. It's actually Social Security and Medicare on the business side as a business owner, and then Social Security and Medicare as an employee, which adds up to the same amount, 15% roughly, which is self-employment taxes. But you're going to pay self-employment taxes on that salary piece that you take. But here's the beauty with the S corporation. Any income your business makes over and above your salary, you just take as an owner's draw, a dividend, a distribution, and that is not hit with self-employment taxes. And so this is really where the beauty behind an S corporation makes sense, because now instead of paying self-employment taxes on 100% of our income, we're splitting that income into a portion and we're paying self-employment taxes on our salary, but our distribution piece, we're avoiding that self-employment taxes completely. And this is kind of the main reason on why are we looking at S corporation, to eliminate or reduce the amount of self-employment taxes that we pay. And so when we look at them side by side, in this example, we just threw that revenue number and expenses. That number is not as concerned. The number we want to focus on is what is that net? What is that profit that we have? Let's look at these side by side. As a sole proprietorship, single member LLC, if you have $80,000 in profit, you're going to pay self-employment taxes of roughly $11,000. That's, again, over and above your normal income tax rate. With an S corporation, though, let's say we determine for you at that $80,000 in profit, a reasonable salary for you based on the amount of hours you're working is $36,000. So in that case, we're going to pay yourself as a W-2 employee of your company, we're going to pay yourself $36,000, and you're going to pay self-employment taxes on that. That's going to be roughly $5,500 on just that salary portion. But now the remaining portion, that remaining $44,000, 80 minus the salary that you took, the remaining $44,000 is not hit with self-employment tax, and we avoid it completely. So in this scenario, we're saving, a little over almost $5,800 in self-employment taxes simply by electing to be an S corporation. So that is a great question, a great way that we can avoid or eliminate a portion, or reduce a portion of our self-employment taxes. Now, again, the big thing with an S corporation is that you have to pay yourself as a W-2 employee. You have to withhold all those taxes and do all that. So we recommend using a payroll provider, which is going to have some cost to it. The second pain is that you have to file an S corporation tax return. Typically, an S corporation tax return is going to be a little bit more complex than your traditional tax return, and likely going to have a little bit more cost to it. So now you're still filing your personal return, but you're also filing a business tax return. Those are the two downfalls of an S corporation. And that's why we say once you hit that profit of $40,000 to $50,000 or more, that's where the S corporation is going to make sense, because your tax savings are going to far more outweigh the cost to do payroll and the cost to do that extra business tax return. Next slide. So the next part will be Darren, but I just want to kind of reiterate that idea. Again, we want to be thinking consistently, how can we take after-tax dollars, spending that we're already doing, and turn it into pre-tax spending? Find a business purpose for it and run it through the business. If you've already done some this year, maybe do a reimbursement of yourself to reimburse for that business portion of items that you're doing. And that's where we kind of get creative in this idea, whether we're hiring our kids, whether we're doing the Augusta Rule, whether we're going out to dinner with a friend that maybe is a client, or a friend that is an employee of ours, or whatever it might be. We're finding that business purpose in the everyday spending that we're doing anyway.
Okay, great, Mike. Thanks so much. And so we're going to try this again. Now, Mike, am I coming through clear here?
Yeah, everything sounds good now on my end. Yeah.
All right, we had technical difficulties. I turned off my video, so hopefully that reduces the strain on my bandwidth here.
Yeah, you sound great now.
Okay. Are there any questions for Mike before we move on to some of these other topics? Feel free to pop anything that you think of in the chat box, and we'll be happy to answer any of those questions as we go along. And of course, if you came in late, don't worry about it. We are going to be sending out the recording so you can catch anything that you might have missed, or if you want to rewatch. Okay, so I'm going to go over a couple ideas here for other ways that you could reduce your taxes both now and over the course of your life. We'll talk about retirement savings, the Stealth IRA, deferring contingency fee compensation, tax-efficient investing, and life insurance as a potential way to reduce your tax burden. So let's start off with the first one, retirement savings. And just some of the basics here that you may already be familiar with, but in case you're not, a retirement savings account or retirement plan can be a great way to reduce your taxes. Of course, everyone can put money in an IRA as long as you qualify for it. If you don't have an employer-sponsored plan, it doesn't matter what your income is. You can put $6,000 into an IRA and get the tax deduction, and you get an extra $1,000 if you're over 50. If you do have an employer-sponsored plan, there is an income limitation that you have to be under in order to qualify for that. Now, one of the great things about being a solo attorney or part of a small firm is you can really take advantage of the ability to set up your own retirement plan and really get some really great benefit out of it. So some options for you might be the simple IRA. With that, you can contribute $13,500 pre-tax, an extra $3,000 if you're over 50. If you have employees, you'll need to allow them to participate. I think the time frame is 3 years, so you have 3 years of vesting or eligibility. You don't have to allow them to participate until they've been working there for 3 years, I think. And then at that point, you have to give them either a 2% automatic contribution or a 3% match. The SEP IRA is really, really popular because it allows you to put away $58,000 pre-tax or 25% of your compensation, whichever is less. So you can really funnel a lot of money away on the pre-tax side. The only problem is if you have employees, W-2 employees, whatever percentage of your salary you're giving yourself, you have to also give to your employees. So that becomes a little bit more challenging once you have other employees or other attorneys working with you in your firm. Then you might be in a situation where you want to consider the 401k. And actually, I like the 401k for solo attorneys too, and we call that the solo 401k because you get all the benefits of the SEP plus some extra bells and whistles. So with the SEP, with the 401k, you as an employee can make a $19,500 contribution plus an extra $6,500 if you're over 50. Now that can be either pre-tax or it can be Roth, and we'll talk about that, what the difference is there in a moment here. The total amount that you can contribute is $58,000 combined for the employer and employee contribution, plus an extra $6,500 if you're over 50. To get a little bit of a catch up, and I think the solo 401k is also limited to 25% of your compensation. So, but you just get a little bit extra that you can put in there with the 401k. Now, if you are really cranking it out and just having great year after year after year, and you're really looking for some money, a way to put money away, you could explore the cash balance plan. Cash balance plan is technically a pension plan, but it functions kind of like a 401k. And basically what you can do is you can put away a lot more money pre-tax. The amount you can put away is a formula that's really based on your age and your compensation. And it's a little tricky to figure that out, but you could potentially put away up to $343,000 a year. Now, that's going to be, if you're really, up there in the tax brackets on a consistent basis, then that might be something you want to explore. One interesting thing about the 401k, that employer portion, whatever's above that $19,500, that can be a variety of different things. That can be pre-tax, or it can be after-tax money, or it can be a profit sharing amount, which is a little bit more flexible. So with a profit sharing, you can give that to only certain individuals. You have to make some classifications, right? So you could give that only to the attorneys versus the support staff. You can do some interesting things there with profit sharing. So retirement savings is going to be one of the best ways to reduce your taxes, is taking advantage of a retirement savings plan, making sure you're getting taking maximum advantage of the one you have. Love the solo 401ks. Mike is saying he loves the solo 401ks for attorneys. I have a solo 401k for myself. It's fantastic. It's really, really easy to set up. You just have to do, kind of keep track of what kind of contributions you're making. That's easy to do. You put it in an Excel spreadsheet or something and make sure it's saved on your computer. Also, Mike was talking earlier about the LLC option and the S Corp strategy. That is a really, really great, fantastic idea. In fact, that is something that I do myself. So we practice what we preach over here. All right. So next up, let's take a look at the Roth IRA. So you have two kinds of IRAs. You've got the pre-tax IRA, and then you have the Roth IRA. With the pre-tax, you're getting a tax deduction today, and then when you take money out in retirement, it's all taxable at your ordinary income tax rates. With the Roth IRA, it's kind of flipped. So you don't get the tax deduction today, but then after 59 and a half, you can take money out tax-free, and that includes your earnings. So all of your earnings are compounding, growing, and that can all be tax-free money. Before I go any further, we've got a question from Randall. To do a solo 401k for a sole proprietorship and small income. Yeah, so you can have, I think I understand what you're asking. You can have multiple retirement plans. So if you have a side gig that you're a sole proprietor, but you're also part of a big law firm, you can set up a solo 401k for your side gig. The problem is those IRA limits those 401k limits apply across the board. So you just have to make sure that between all your 401k accounts, you're not exceeding that $19,500 a year. Okay, and then the combined $58,000 total between employer and employee contributions. So, let's say you are maxing out your 401k with that $19,500 at a big firm that you work at, and then you've got a side gig, you're making some extra money, and whatever you have up to that $58,000 mark that's left that you are not taking advantage of could be an extra pre-tax contribution to a solo 401k. So yeah, that's a great question. You can have multiple plans that you're a part of. You just have to make sure that across all of them combined, you're not exceeding those 401k limits. I hope I answered that question, Randall. If not, send me another message and I'll make sure I try to clarify. Okay, so for the Roth IRA, an interesting idea, and I'm getting a lot of questions about this, is you can convert IRA money over to a Roth IRA. And the only thing you have to do that is pay the taxes. So let's say you've got $100,000 in your IRA and you want to bring some of that over to the Roth side. Well, you could take $20,000, you convert it over to the Roth, you're going to have an extra $20,000 in income you're going to have to pay taxes on, but then that $20,000 is over in the Roth and now it's growing and compounding, and in the future it will all be tax-free. Now, why would you want to do this? Well, it might make sense, it can make sense in a couple of different circumstances. Let's say you have a particular year where your income is really low. That would be a great year to do this because you're going to be in a low tax bracket and you can take advantage of being in that low tax bracket, lock in a low tax rate on some of that IRA money and flip it over to the Roth where it will then be shielded from any future taxation. That could be a great idea. This was a great idea, let's say during the pandemic, if your income was down, that was a great time to do this. Or another idea, let's say you have a bunch of after-tax money, like in a brokerage account, and you're not taking advantage of your Roth IRA contributions. Well, you should slowly start transitioning that money over to the Roth because then it will be protected from taxes on any of the earnings going forward, which is really nice. Another reason you might consider the Roth is for reducing future RMDs. I have a client, we're working on this right now. He's got a whole bunch of money pre-tax, but he's not going to need it necessarily, and he's worried his RMDs, and then he's going to have all this tax to pay. So we're strategically trying to move some of that over to the Roth side. Another idea is tax insurance. So, and this is really the thing that people are concerned about right now. Everyone's concerned that taxes are going up in the future, and they may. Having some money in the Roth side can be a form of tax insurance because you have money you can pull from that won't be taxed. Now, in retirement, you may very well be in a lower tax bracket than you are now. So there is that to think about. But, insurance is one of those things that's not guaranteed to give you a benefit, but when you need it, you're sure glad you have it. So just in case taxes should go up significantly in the future, it might make sense to have some money on the Roth side. Another one that I learned this year was protecting your spouse. So if you are married, you and your spouse, you retire, and let's say one of you passes away earlier than maybe you anticipated. Well, two things are going to happen. Number one, your income is going to go down because you're going to lose one of your Social Security benefits. The other thing that's going to happen is you're going to go up into a higher tax bracket potentially because you're going to go from married filing jointly tax brackets to single tax brackets, which are not as generous. So you could be in a situation where your income goes down and your taxes go up. And one way to mitigate that risk is to have some money in the Roth side that you could pull from later on down the road. And finally, for legacy purposes. Roth IRAs can be passed on to your kids tax-free, and that's really, really nice. So unlike the IRA, where when you pass it on to your heirs, then they have to pay taxes on any of that money. Okay, so just some ideas there. You might consider the Roth. I'm not saying it's necessarily the best thing for you. Your circumstances are going to be very unique, of course, and it's important to talk to somebody and figure out what's going to be best for you. And really, it's a question of, do you want the tax benefit today, or do you want it down the road in the future? But here's an interesting way of looking at it. Oops, I think I went too far here. Let me go back. Which is more here? Let's say you've got $500,000 in an IRA or $500,000 in a Roth IRA. Well, the IRA has a certain amount that is really the government's money because it's taxes that haven't been paid yet, whereas the Roth is all yours. So, the Roth is not a bad idea. I like the Roth. I know a lot of CPAs don't because they, it can be beneficial, if you're going to be in a lower tax bracket in retirement to do the pre-tax IRA side. Like I said, it's really just going to depend on you and your circumstances. Okay. Next, let's talk about this idea of filling up your 401k. So this is an interesting idea. Now, you can take advantage of this strategy if you are at a big firm or if you have a solo 401k. Either way, this is something that you could potentially take advantage of. So in your 401k, you can contribute a maximum between both employer and employee money of $58,000. So let's say you're maxing it out. You put $19,500 in, and then let's say your employer is also matching that with an extra $19,500. That would be really, really nice. Now, if that's the case, you have an extra $36,550. I hope I did my math right. Maybe not. Anyway, you have some extra money that you could put in there. You're not filling it all up all the way, So let's see. I think I did the math wrong. 19,500 times 2 is 39,000 and minus 58,000. So you've got an extra 19,000 that you can put away. Ignore that 36,000. I don't know where I got that number. Anyway, basically you have some extra money you can put in there to fill it up. What you're going to want to do, what you could do, is you could put an extra $19,000 in as an after-tax contribution, not a pre-tax contribution, not a Roth contribution. It's an after-tax contribution. Then you can take that and you can roll it over to a Roth IRA. You could leave it in the plan. That would be fine. But then any of your earnings are going to be taxable down the road. But what you would want to do is take that after-tax money and roll it out to a Roth IRA, and then any taxes on that would be, you wouldn't have any taxes on the earnings in the future. So this is going to be a kind of, dependent on whether or not your plan offers it. So let's say you're part of a big firm, you've got a big 401k plan you're part of, you would want to ask your administrator, am I able to make after-tax contributions? And secondly, am I able to take distributions while I'm still employed of that money to roll that over to a Roth IRA? If you're able to do both of those, this is something you might want to explore. It's a way that you can funnel more money into that Roth side and really maximize how much you're putting over there. Mike is saying, Darren, can you explain a rollover if you have other IRA funds on top of your current year after-tax contribution? Oh, okay. So most of the time, okay, so are you talking about the backdoor Roth?
Yes. Yeah.
Okay.
So like an example would be, let's say you had an IRA with $50,000 you had for say 5 years or 10 years or whatever, and now you want to do this after-tax contribution and just roll over that after-tax one. Is that possible?
Yes, and that's kind of unique with the 401k because they are kind of kept in separate buckets. So you can roll just the after-tax amount out. Now, the IRA is different. This is just the 401k. The IRA is a little different. So, you may have heard of the backdoor IRA Roth contribution, which is just making an after-tax contribution to your IRA and rolling that over. You can do that, but the problem is if you have pre-tax money that's already in there, then when you roll money over to the, or convert money over to the Roth, part of it's going to be taxable. Okay. So that's where you can get in a little bit of trouble if you're doing a backdoor IRA contribution that way. But with the 401k, it's a little bit special because these are maintained kind of in separate buckets, and that's kind of unique to the 401k. But yeah, Mike raises an interesting idea too. You can do a backdoor Roth contribution through your IRA. The best way to do that is if you have no money in the traditional IRA, because you want to make sure you don't have any extra taxes that you're paying. Okay. If you want to know more about that, you can talk with either Mike or myself. We can help you figure that out. Okay. Next, I want to bring up the Stealth IRA. I mentioned this, and maybe you were trying to figure out what that means. The Stealth IRA is just a health savings account. The reason I call it a Stealth IRA is because it can operate kind of like an IRA and kind of like a stealthy way to save some money on taxes. So with a health savings account, you can contribute a maximum of $3,550 for individuals or $7,100 for families, and that's pre-tax money. So you can deduct how much you put in there. You are eligible for an HSA account if you have a high deductible health plan. And there are specific numbers that I can show you to figure out that if you don't know if you are on that. But a lot of solo attorneys do have their own health plan and probably are on a high deductible plan because they're less expensive. So with a health savings account, you make a contribution. It's pre-tax, so you're getting a tax deduction. Then it grows, and you can use the earnings tax-free and the money in there to pay for qualified health expenses. So it's kind of like a double tax advantage. Now, let's say you've built up money in your HSA and you get to retirement age, you got a lot of money left over. Well, after age 65, any money that's left over, you can take out without penalty, but you do have to pay taxes. So it functions kind of like a traditional IRA. So it could be an extra supplemental retirement savings vehicle and an extra way to get some more tax deductions and save some money on taxes. Another interesting idea, this is very unique to just attorneys, is deferring contingency fee compensation. This is going to apply to those contingency fee attorneys, like personal injury attorneys. Let's say you've got a really big case and you get a really big payout. Well, then you're going to have a really big tax problem. If you get $1 million payout, let's say, you take it immediately in this year, all of a sudden you're being ramped up into the very highest tax bracket and you're paying a whole bunch in taxes. Well, one way you can help mitigate that problem is what we call a structured fee arrangement. A structured fee arrangement means you're going to take that $1 million, it's going to go into a trust account that's not yours, that you don't have technically ownership of, and then you're going to receive it a little bit at a time over a period of time. That way, you can defer some of that taxation and hopefully keep yourself in a lower tax bracket so you're paying a lower tax rate. So let me give you a little example of how that might work. So let's say you have a $1 million payout, you take that immediately, you're going to pay maybe, let's say, 40% in taxes, so you pay $400,000, you got $600,000 left over to invest. Let's say you invest that at an 8% rate of return, but then it's after-tax money, so you have some capital gains and dividend taxes to pay along the way. So let's say there's a 15% tax drag. After 10 years, your after-tax value is $1.1 million, $1,158,000. Okay, the structured fee option, take that $1 million, you put it in the structured fee arrangement, boom, all $1 million goes into the investments immediately, minus maybe some setup fees. At an 8% rate of return, you don't have the tax drag from dividend and capital gains taxes because it's all tax deferred. You end up with $2.1 million. Now, if you pulled it all out right away, you certainly would have a lot of taxes to pay. So let's say you pay that 40% rate. Well, you have $1.295 million, which is a little bit more. That's $140,000 more approximately. And if you took it out slowly over time, maybe you stay in a lower tax bracket, you're going to have even more after-tax money. So just to illustrate how that can potentially be valuable. Like I said, feel free to ask any questions as we go along. I know there's a lot of stuff. We're going to breezing right through here, but hopefully it's making sense to you. Next is life insurance. A lot of times life insurance is pitched as a way to defer taxation. I'm not a big fan. I'll just be honest right up front. But, there are some potential uses for life insurance. It can be a way to provide, to reduce taxes and pass wealth and income, wealth tax-free to your heirs. This is because cash values grow tax deferred inside the policy. At retirement, if you have a cash value life insurance policy, you can take loans from the policy without taxation, and then you can use that money basically to supplement your retirement income. When you pass away, any loans that are still remaining are just paid off from the death benefit. There are some downsides, of course. Insurance is expensive. You have limited investment options. If you have investment options at all, whole life has really low interest rates because we're in a low interest rate environment. So there are a lot of downsides to consider. But there is one potential really great way to use life insurance, and that is for a non-qualified deferred compensation plan. You may have heard of this. Basically, it's a way that companies offer special retirement benefits just to certain executives or highly compensated employees. Typically, so with a 401k, you have to let everyone participate. But this is called a non-qualified deferred compensation plan because it is only offered to specific individuals. So this is how it works. The firm obtains a life insurance policy on the partner and pays the premiums. When the partner retires, he or she can access the accumulated cash value tax-free. If the partner dies, then the death benefit can go to the partner's family or be used to reimburse the firm. There are many different ways to set this up, and it can be very complicated, but that's kind of the Reader's Digest version of how it works. And if you want to know more about it, you can set up a meeting with me and we can talk about it. Finally, tax-efficient investing. So, and this is, if you have money that you're investing outside of your retirement plans, you want to make sure that you're trying to do that in a tax-efficient way as much as possible to reduce capital gains taxes and dividend taxes. So really just take a long-term approach, try to minimize your buying and selling, or if you are buying and selling, try to make sure that it's been 12 months, because at 12 months, you're in those long-term capital gains rates. You can take advantage of tax loss harvesting, and this is going to be really popular here as we're getting close to the end of the year. Let's say you have some positions that maybe you've lost a bunch of money on, and probably not this year because the market and everything has just gone bananas. But if you have a holding that has gone down and you haven't made any money on it, sell it. You have to wait 30 days, and then you can buy it back. You can lock in that tax loss, and you can use that to offset some of your gains. Also, make sure you're using tax-efficient funds where possible. Index funds, ETFs, individual stocks are actually very tax-efficient most of the time, unless they pay a significant dividend. If you have a lot of money outside your retirement plan, you may want to think about a low-cost, investment-only variable annuity that you could use as a tax. Okay, I'm running out of breath. I've been talking a lot. So if there are any questions, feel free to pop those in the chat box there, and we would be happy to answer any of those questions. We went through a lot of great information here. There are a lot of unique ways that attorneys can reduce their taxes, especially solo and small firm attorneys, which are the really most of my clients. And I, because my technology wasn't working, I wasn't able to do my intro. So I'll just do it now. I'm Darren Wurz. Some of you on the call know me. My company is Wurz Financial Services. I specialize in working mostly with attorneys and couples who are near retirement. And for my attorney clients, tax savings is really a really big topic. Some ways that you can connect with us and follow up. Visit I've got my Facebook page up there. You can connect with me on Facebook, on Twitter also, twitter.com/WurzFinancial. And we also have a blog that you can see. We put out a monthly topic on there that you can learn from. I'm not quite as advanced as Mike. I don't have a podcast yet, but I am planning on starting one. So stay tuned. And also, I forgot to mention this, I have a book coming out next year that's going to be published by the American Bar Association. tentatively titled The Lawyer Millionaire. And we're going to be talking about, in that book, all kinds of ideas on financial planning and maximizing wealth, planning for retirement for attorneys specifically. Mike, you want to talk about some of your resources here that you've got?
Yeah, and I would definitely want like a signed copy of that book when it comes out. Yeah, so as far as where you can connect with us, if you join our Facebook group, we share a lot of information there. And if you have additional questions, feel free to join in. Just search Facebook Small Business Tax Secrets, you'll find it. We also, as Darren mentioned, have a podcast and a blog. We do weekly episodes. We talk about tax strategies. And if you go to taxsavingspodcast.com, you'll find our podcast and our blog right on there. When we talk about tax strategies, we have things called baseline tax strategies. These are things that we typically say are easy to understand, easy to implement. This is going to be things like an S corporation, hiring your kids, doing the Augusta Rule, those types of things, setting up retirement plans. Those are what we call baseline tax strategies. That's much of what we talk about on our blog and podcast. We also then have our tax minimization program. And this is a monthly program. We call it kind of an accountant in your back pocket, where you have access to a bunch of tax strategies, implementation guides, how to do it yourself. You also have access to our team for general tax and accounting questions. And we also do a monthly group training where we deep dive into a specific tax strategy. Within our tax minimization program, we also dive deeper into this idea of advanced tax strategies. So if you have income in the $250,000 or more range, that's when you start to qualify for what we call advanced tax strategies. These are normally just a little bit more complex, but can provide massive tax savings and really valuable stuff. We also obviously go through everything on the baseline side as well. So best place to find us is taxsavingspodcast.com. Otherwise, the name of our podcast you can find on any podcasting platform is Small Business Tax Savings Podcast.
Very cool. Very cool. I'm going to go check that out myself. I want to know more. Very cool. Great resources. Now, if you want to take the next step, you can schedule a free consultation with either me or with Mike. Mike's got his calendar page up there, harmonizely.com/M Jesowshek. You can schedule a meeting with Mike and figure out some tax planning for yourself before the end of the year here. And then also my calendar is there, calendly.com/Darren Wurz. You can click on that, or I don't think you can click on it, but you can type it in and you can go to that page and you'll see all of my availability too. Thank you so much for joining us today. This has been great. Sorry, we had a little bit of technical difficulties in the beginning there, but sounds like we figured it out here. Mike, any last thoughts?
No, thanks to everyone for joining. It's always a pleasure kind of going through this. And just remember, when you're thinking about tax planning, that oftentimes 12/31 is an important deadline. Sure, there's some strategies that we can utilize after tax season, or after the year's over, but majority of tax savings need to be done before year end. So take some time, do some research now, and make sure you're paying the least amount in taxes as legally possible.
Absolutely, yeah. So don't delay. Go ahead and get that meeting scheduled so you can figure some things out before the end of the year. Randall said, "Use your tax savings for better Wi-Fi." I agree, Randall. I need to upgrade, I think. I appreciate that. So, hey, thanks everybody for joining us. It's been a pleasure, and hope I'll have a chance to talk to you soon.
Thanks, guys. Have a good day.
All right. Bye-bye.